scheme here in Canada that we're required to use. And we're going to give you an example of the normal case. Now, the normal case is, one, a company is making money, i.e. they have taxable income, therefore they pay tax. Now, that's important because the formula that we're using is DTS, depreciation tax savings, and that is equal to, let's say, in period K, equal to the tax rate times the depreciation in period K that this method allows us. So if we're not making money, we're not paying taxes, we can't save taxes, hence depreciation is worthless. We don't lose anything, but we're not allowed when we're not making money to take depreciation. That's really point 6 there. And the second part of this, that's sort of an abnormal situation, if we're in a situation where we're getting government assistance, so they're helping us to pay for part of the asset, then they say, well, we paid for part of the asset. On that part, you're not going to get depreciation tax savings as well. So we need to take the investment tax credit or whatever preferential treatment we're getting out of our cost base and depreciate the balance. So it's like we don't get it twice. We don't get depreciation tax savings and to have the government or the taxpayer paying for assets at the same time. So that's really number 4. Okay. Those are the 2 special conditions. The rest of that really is probably easier to explain it by way of an example. And I'd like to carry through on my brother example that I looked at from a straight line depreciation point of view, where we talked about why the government doesn't like that method in terms of coming up with it for tax purposes. So here we're going to use declining balance, which is just a general method within the context of capital cost allowance, which is the set of rules that I just put up. Okay, so what do we need to know? Well, we need to know the nature of the equipment. In this case, it's general purpose electronic data processing equipment, their term for computers from about 25 years ago, including system software. And so it'd be bundled into class 10, as we'll show you in a second. So CCA, or that little p, is 30%. That's our depreciation rate. Again, we need to look at everything that went into getting it up and going, the first cost. So it's the cost of the equipment plus installation. So the electrician fees or whatever to get it installed. So we have $10,500, which we call our cost base, or cost base. It is that basis that we use for depreciation. Now, as I mentioned, I think the other day, the government says, on average, companies own an asset in the first year for half a year, right? If I buy it in January, I'm holding it for 12 months. If I buy it in December, it's 1 month. Or December 31st, it's 1 day. So on average, in the first year, it's 6 months. So government doesn't give companies the entire year's depreciation. In the first year, simply half. That's just another way of saying they don't want to give as much depreciation as a whole year's worth because it reduces revenue to the government. So on line 1 there, you're seeing that half-year rule is ignored. I've got $10,500 worth of equipment plus installation costs. The first cost, half of it, $5,250, is eligible in the first year for depreciation, and we simply take 30% of that. That's D sub 1, $1,575. Okay, what's the book value? Well, book value is what I started with minus the depreciation, just like Chapter 9, and so I'm left with $89.25. Okay. Well, in the next year, I can add the other $5,250. So I've got an eligible pool of $10,500, but I took $1,575 in the first year, hence my book value is really $89.25. So take 30% of that, and you get $26.78. In this method, if you've done your numbers correctly, the second year depreciation is always the largest, or the tax savings is always largest in year 2. From there, it's just straight declining balance. 30% times the declining balance. Okay. And note, in theory, we never get to 0, right? Because the percentage against the number is always non-zero. You get down to a penny sooner or later, but a long time from now. Okay. So this is the normal case for most of our engineering projects. 1, we're making money. Therefore, the depreciation has tax savings. And 2, we had to pay for the entire thing ourselves. We're not getting taxpayer dollars. Okay. If we are not making money, perhaps, let's say in the first 2 years, then the depreciation we can't take. You can't take depreciation if you're not making money. You're not saving any taxes. You're not going to take it. So in that case, the book value, let's say year 3, will be $10,500, simply because we haven't taken depreciation in year 1 and 2 because we haven't made any money. And then it goes normally from there to declining balance. Or if the government, let's say, gave us $5,000 to pay for this thing, then we have $5,500 left. That's what we depreciate. Those are the 2 special cases. But this is the normal business situation. Okay. Okay. Now, what's the value then? Okay. Well, it's the present value, essentially, of D1 through D infinity, essentially, or as long as I keep the asset. Let's say I'm keeping this asset for 10 years. I'm going to sum up D1 through D10 in terms of depreciation, tax savings. So it's really sigma DTS 1 through 10. Take the present value of that. That's the value of depreciation for tax purposes. You don't see that in Chapter 4, but Chapter 5, it indeed is something that's valuable because it reduces the after-tax cost. I've got some formulas that will help you calculate that if you're keeping an asset for a long period of time. Okay, so how does it work in Canada? Well, I'd like to show you that indeed all of this, I'm saying let's just taxes that can possibly affect engineering design or my competitiveness of my company. Well, I'd like to show you that by looking at the Tax Act and trying to design your equipment in an optimal manner, you can create significant value. And if you don't, you're not going to sell your equipment in Canada because other companies have exploited the Tax Act in that manner. Remember the two terms, tax avoidance, tax evasion. Tax evasion is essentially doing things illegal, not allowed, and that's what we're talking about. But by juggling your design around to take advantage of what's in there, it's called tax avoidance. Perfectly legal, and indeed mandatory if you want to sell in Canada. Okay. So have a look at the way this works. We have these classes, so assets of a similar nature are pooled together into a class. And we basically deal with, let's say, all of our computers together in, let's say, whatever that is, class 10. So they're pooled together, and we get 30%. What you'll see is generally, the longer the expected life of the asset, the smaller the percentage, i.e. the longer it takes you to depreciate, which makes sort of sense, because what's depreciation? Well, it's flowing out the cost of the asset over time. The longer the asset has its life, the longer time you've got useful use for it, and the longer time you're going to spread out those costs. Okay, so telephone wire, cables, poles, those sorts of things, they last 20, 25 years, 5%. Okay. Something like software, well, it has a very, very short life, and the government says write it off 100%. Subject to the half year, that's 50% now, 50% next year. Okay. Other things have a very long life. Fiber optic cable, for example, has a very long life, 12%. And so that's the general thrust of things. The longer the life of the asset, the longer it takes you to get the tax savings. Now, I'd like to just point out Class 30, an unmanned telecommunications spacecraft designed to orbit above the Earth, also known as a satellite. But heaven forbid they wouldn't use that word in the tax act. 40%. That means that over 2 or 3 years, you're going to write the value of the satellite off, which by my reasoning would mean that satellites have a very short life. I can put it up, and it comes down in 3 or 4 years because I'm writing the value off. Well, that really is not the way satellites have a long life. What we're seeing here is government policy. If, let's say, we said a satellite had a 10-year life, we would probably write this off at 10% a year. But the government wants to encourage Canadian industry to use satellite equipment, and therefore is giving preferential tax treatment. Think about the tax savings if I can write off 40% of the value each year. All of that occurs very early in the project, which, as we'll see, adds value. So what you're seeing here is an exception to the rule. You're seeing government policy saying, we want to encourage the satellite industry in Canada, and we're going to make it very favorable for those players to use satellites because of tax savings. So essentially, you've got government policy. Now, the other point here is that if the government hasn't incorporated a particular asset into the Tax Act for whatever reason, there's a catch-all, Class 8. So property not included in any other class, which is 20%. So oftentimes the technology, government's a little bit slow. When you have new technology, it doesn't show up. So it basically is handed to Class 8 until they figure it out. Okay. Any questions about that? Okay, let me show you an example where this actually can affect engineering design. And it's a telecommunications example, and it's an example of a telephone switch. It's a large switch which phone companies would buy. So think about a central office at a phone company, and you've got 10,000 pairs of cable coming in, hooking up all of the residences or businesses to the switch. So it's a large switch, large, say 10,000 line switch. Okay. And for the sake of argument, it's worth 10 million. using this equipment for profitable purposes, therefore they are allowed to depreciate. Now let's put ourselves in the shoes of the product line manager at the company making the switch, trying to decide, well, how are we going to engineer it? Okay. And what's the best thing to do in terms of reducing the after-tax costs? Because phone companies are tax-paying organizations, and they, of course, will look at equipment that minimizes their after-tax costs. They're not looking Chapter 4, they're looking Chapter 5 P&L. So if I look at the schedule, the things that basically are allowed for me, I'm going to have a look and say, well, it's a telephone switch. So if I'm looking here, what do I have? I've got telephone or data communication switching equipment, excluding equipment installed on customer prem. Okay. In other words, stuff in the central office. So class 17 appears to be the applicable number. Okay. And it's 8%, reflecting that switches have a fairly long life. You put one in, and you get a 15, 20-year service life out of the jet. Okay. Now, what I want to do is look at it from the phone company's point of view, the customer point of view. And let's say we sell the switch, not surprisingly, as a switch. And let's ask the question, what are the tax savings to the customer in year one? And can we do anything through design to maximize that number? Well, I've got a $10 million switch, okay, and our customer is in Canada, therefore subject to the half-year rule. So in the first year, $5 million is eligible. We've said it's class 17, and therefore the depreciation is 8%. And so this is D1, depreciation in year one, and therefore depreciation $400,000. What we're really after is DTS. That's the tangible savings for the company. Phone companies are always profitable, therefore they pay tax. Therefore, this is going to be valuable to them. How valuable? Well, let's look at DTS1. It's going to be T times D1, or I'm going to say the tax rate, just to make the numbers easy, is 50%. Too high, but I'm just going to leave it that way. So it's 0.5 times D, or 200,000. So the way to interpret that number is, if the company doesn't buy the switch, they're going to pay tax. If the company buys the switch, they are going to pay $200,000 less tax. Therefore, a benefit associated with buying the switch is a positive cash flow of $200,000. Tax they wouldn't have to pay as a result of buying the switch. Therefore, it's a very real benefit. It's tax, it's a cash flow. Very real benefit of the switch. Okay. A fairly small benefit, though, on a $10 million acquisition. And my question is, if we're clever, can we do any better? Look at this $10 million telephone switch. And what is it? You might want to think, how can I do better? Telephone switch, isn't it basically a computer? Why don't I call it a computer? Why would I want to do that? Well, if I can call it a computer, it's class 10. And 30% a year is significantly higher than 8% a year. So the tax savings will be greater. Is it a general purpose computer? No, it's a very specific telephone switch. Tax evasion or tax avoidance? Tax evasion, if I declare it to be a general purpose computer. What about if I put one workstation on it and run Windows? So I get this $10 million telephone switch, which is now a general purpose computer, because I got one terminal that can run Windows. What do you think? You gonna buy it? Tax avoidance, or tax evasion? Well, perhaps the general anti-avoidance regulation, which says if you do something for the sole purpose of avoiding tax, then we don't like it, and Revenue Canada, we're going to disallow it. Think in your right mind, who would put Windows on a $10 million switch to have one station? So the answer is, that is not feasible. I mean, that would just get thrown out the window. What about if I'm really clever, and what I really want to do is look at class 12 here, 100%. Isn't a telephone switch a stored program computer? i.e., it has a program in it. What about if I were to sell the switch for $1 and the software for $9,999,099, whatever number, $999? Okay. Doesn't that accomplish what I want to do? Now, $1 gets depreciated at 8%, and almost $10 million less a dollar gets depreciated at 100%. And all of a sudden, far more valuable tax savings. Now, I'm in charge of pricing. Can I not do that? What do you think? Is that a normal arrangement? What's the test in the marketplace of that being a normal arrangement?
No, it's part of the avoidance.
I think it's avoidance.
Yeah, because
Well, yeah. But what would be the true test of whether that's a reasonable number? What about if a customer came up to me and said, "I only want your hardware, and here's $1." Would I sell it? Absolutely not. Therefore, general anti-avoidance says, I've set this up simply to avoid taxes, therefore, it's no good. But am I onto something? Think about this thing, worth $10 million. Doesn't it have a value in hardware, and doesn't it have an equal value in software? I mean, I know you can't touch, but programmers add value, right? So, why don't I try to exploit the Tax Act by saying, I've got hardware and I've got software. And I know software gets preferential tax treatment. And the true test in the market is if someone wanted to, let's say I declare my hardware to be worth $5 million. Well, the true test is that someone says, I want your hardware, not your software, here's $5 million. If I sell it, that's a legitimate transaction. So what do I need to do? I need to somehow or other justify a split between hardware and software. Well, our friends over in industrial engineering are very good at doing cost accounting, cost engineering, what have you. And we were forced into court, defend a position that says so much of the value is hardware, so much is software. Now, does that do anything for our customer? Because remember, we want to sell, and we want our customer to have the lowest after-tax cost. Well, think about this now. If, for the sake of argument, I'm going to say that the hardware now is worth $5 million. And let's say this is, if I go to court, I can prove this, plus or minus a little. Okay, which then means that the software is worth $5 million. Well, what does that do? Well, I can't do anything about the hardware, right? Because it's class 17, 18%, 8%. And I have my half-year rule, okay? And so D1 is going to be 400,000. Is that right? No, 200,000 should be half that number. Right? What am I doing? Yes, 200,000. Okay. And the software, though, which now we got to see what type of software it is. Let's say our engineers, usually in these stored program machines, put the software in read-only memory. Okay. Well, if I'm going down here, basic software and firmware and central office equipment is 20%. Right. This is a stored program machine, so you store the program in non-volatility. And so I can now say class 8, which is much better, 20%. Okay. But I really have my eye on class 12. So if I put all of the software into read-only memory, as it were, it's firmware, and get 8%. If I'm really clever, I'm going to look at the software and say, well, what is it really? Isn't it application software, right? Call forwarding, voice messaging, call back when busy or whatever. All of these features are applications. So why don't I say it's application? And rather than storing it in read-only memory, which makes it automatically class 8, let me put it on a USB key, plug it in, and now it's software, it's application. And all of a sudden, I've depreciated 100%. Evasion or avoidance? It's avoidance. I'm doing exactly what they said. I got application software. I'm not putting it in firmware. I'm putting it on a USB stick. I'm loading it in, Volatile memory, class 12. All of the 5 million? Well, probably not. There's an OS, an operating system probably in this switch, which does sit in read-only memory. So what about if I were to do that? I'm going to say I've got application software, because that's where most of the value is. So I've got application software to the tune of 4,990, okay, which is class, what is that class? Class 12. Okay. And I've got OS software, 10,000. And I'll get my cost engineers to come up with a reasonable number, which is class A. This is class 12 and 100%. And this is class A. Now, back to our what? Our 12%. 20%. Well, what does that do to this company? Well, think about D1. D1 here is now 200,000. Okay. On the software, remember, half your rule at 100%, it's 2,495,000, and on the OS, it's 1,000. So your total depreciation is around 2.7 million. What's DTS on that? Well, DTS is 50%. So DTS 1 is going to be 1.348 million. Those are tax savings that immediately hit the bank account. So in the one case, not knowing anything about the income tax and engineering your switch as a switch, putting everything where you want in read-only memory, saves the company $200,000. Knowledge of the Income Tax Act and a slight redesign, and what's all that extra going to cost? $1,000 maybe. Saves the company $1.3 million. I guarantee you that if you sold a switch in Canada like this, you wouldn't sell a single one, right? Because your customers, or sorry, your competitors are going to be doing this one, and the company's going to look for it after tax costs. So in terms of the total value of all of this, it is very, very significant. Okay. So engineering design can be influenced by the tax act in terms of making sure that you're aware of what's going on and how you structure things to maximize the depreciation. Okay. Any questions? Yeah, please.
So you sell the switch in different countries, could you introduce that as well?
Yes. Yeah, you then, that's a really difficult job in terms of world trade. First of all, you have to know all the nuances in marketing and language and what have you to make sure that you don't call it a car a Citroen lemon, right? Because that's not good. And then you have to know all of the intricacies of the Tax Act because it's different everywhere. I'm going to show you what happens in the U.S. totally different from what we have. So yeah, it becomes you have to do it all over again in terms of that aspect of the job, marketing and finance. Okay. Now, one more example, and this is where the Tax Act can affect the competitive nature of an industry or business. Okay. And I'd like you to think about this schedule before Class 42 was there. Okay. So Class 42, while we're talking about this example, does not exist. And I'd like to talk about two companies who were both putting in facilities in the expectation that this internet thingy would really grow, and that there would be real market for services, high-speed internet services into residential areas and commercial areas. And Bell Canada was one of them. And so Bell Canada was putting in, this is now a decade or so ago, before there was real demand, was putting in fiber optic cable all over the place. Okay. Sometimes they were mining the copper, taking it out, replacing it. And they, of course, money-making organization, depreciation has value. And so if I look at there in terms of, every year they file their taxes, what are their depreciation tax savings? Well, it looks like Class 3. And so this stuff lasts a very long time. Remember, 42 doesn't exist yet. politicians don't know anything about fiber optics. It didn't happen for a long time. And so they have 5%. A very, very slow conversion of a first expense into tax savings. It's a very, very long period of time. And the present value of the tax savings is very, very small. Now, a competitor was in the very, very same business, putting in the exact same cable with the exact same goal in mind. Rogers was doing the same thing. And Rogers had some really clever accountants, tax accountants. And they had a look at us, and they said, well, you know, there's nothing in the Tax Act. This is not there. There's nothing in the Tax Act for fiber. Politicians haven't got around to it yet. Therefore, it's the catch-all. Class 8. There's nothing about fiber. So we'll go Class 8. And 20% depreciation. I.e., 3 times the tax savings that Bell is claiming. Think about from a competitive point of view, the after-tax cost of huge cost of putting in facilities significantly lower. So Rogers could either make more money than Bell, charging the same, or they could undercut Bell and make the same money. Not a great competitive situation. Yeah?
Sir, what happens when the income tax, the revenue Canada decides that Rogers gets 20% for communication equipment? So,
Yeah, you would say that it's wire, right?
yeah.
So, okay. Well, Rogers basically was called to task, as you would expect. And they said, well, you know, we are prohibited by law from carrying telephone signals. It was a monopoly back then. They were not in the telephone game. And you know, we are in the video business. Well, video at the time was analog, not numbers over a cable. And so they claimed, and they got away with it, that Class 3 did not apply. Because, one, they were in the datacom game. They were putting video, which is analog, and they were, by law, prohibited from being in the telephone game. So they won the day. Okay? Now, what does Bell Canada do? Well, as soon as Bell Canada hears us, they, of course, appeal to Revenue Canada. And they say, well, this is not fair. And so Bell Canada goes to the Revenue Canada department, goes through the process, more senior folks, and the folks there say, well, Bell Canada, this wire that you got, don't you put telephone signals through it? Well, yeah, of course, we're in the telephone business. Where does it say here that it's different? I mean, isn't it a telephone cable or a wire? It doesn't say anything about it being made of copper. It's a wire. It happens to have glass in it. Therefore, your appeal is denied. Class 3 applies to you. And going forward, basically the cost of the tax savings, 3 times almost, Rogers versus Bell in terms of an advantage. Well, clearly unfair because you want fair competition. So what happens? Well, Bell Canada, of course, has folks in Ottawa lobbying politicians, pointing out the inequity of all of this. And, you know, a couple of years later, this process is always very slow. You know, the Assistant Minister of Finance stands up in the House of Commons and, you know, Mr. Speaker, I would like to introduce an amendment to the Income Tax Act. I would like to introduce Class 402 for fiber optics to reflect the nature and growing technology and all these wonderful words about companies using technology in this country. And as you can see, normal Canadian saw it's sort of a compromise. It's sort of halfway between these two numbers. So now, the tax savings to both Rogers and to Bell are exactly the same. So it's competitive pressures now in terms of pricing the product. And so governments, you know, like to make sure that there's a level playing field. And again, if Bell didn't like those, they would be at a serious disadvantage, especially considering how important this is. Okay. So Tax Act can indeed affect competitiveness. And again, you want it to be neutral, right? You want to make sure that if one word wins versus the other, it's not due to a Tax Act, it's due to one company being better than one. Okay. So you have to keep in mind the right questions to ask when you're looking at your design and what can we do. Okay. Okay. Want to just very quickly just show you, and really it's in response to your question, in terms of other jurisdictions. Every jurisdiction virtually every jurisdiction recognizes the fact that when I use a capital asset, it loses value over time. That's a cost, and they allow that to be flowed out over a period of time. No one allows you to write the entire $10 million switch off as an expense right now. Okay. All jurisdictions say it has to happen over time. And in the United States, it's more favorable, as we'll see, than Canada, in the sense that it's an accelerated system. Acceleration simply means the depreciation tax savings are greater, and therefore the after-tax cost of the asset is less. Okay. And Problem Set 3 has an example U.S. versus Canada in terms of locating a project here or there. The U.S. was very concerned back in the 1980s, the Congress, in terms of the aging infrastructure in America. Companies were simply not replacing old equipment with new, and they were falling behind. And other countries, notably Japan, was introducing the latest and greatest investing in technology. And the Congress figured that the U.S. very shortly would be in a very severe disadvantage from a competitive point of view. Well, what do? Well, you can't pass a law saying you've got to get rid of all your old junk and you've got to reinvest. You pass a law that says we're going to use the Depreciation Act to make the after-tax cost of basically renewing your capital equipment much less. And that indeed is what they did. And the system's called Modified Accelerated Cost Recovery System. Very, very simple approach compared to Canada, but essentially the goal is to minimize the after-tax cost of assets. Okay. And it needs to be used for tax purposes in the United States. Okay. So, how does it look like? Well, it's a lot like ours in the sense that assets are grouped together. Okay. And they're given a life, not necessarily their economic life, but for tax purposes, their life. Okay. And for example, communications equipment, 15 years, computers, 5 years. Okay. And what happens is you write off the value of the asset over the class life plus 1, the entire value. Okay. And there are some percentages that guide you in terms of what you're allowed for each class. So here, again, I don't need a salvage value. I don't need an economic life estimation. So I can't play any games. And I'm told exactly what to do. And so all we're doing is looking at the first cost and applying the percentages over the life plus 1 to that asset. Those are your depreciation costs. And we can just give you some examples. Each of these columns should sum to 100% because you're writing off the entire value of the asset. So book value at the end, say on a 5-year asset, at the end of year 6 is going to be 0, because you've written off the entire first cost. So quite simply, you basically take your value of your asset, $10,000, let's say, in the first year, you get a $2,000 depreciation. Similar in Canada, there's a slight reduction in year 1 compared to year 2, and year 2 is usually the largest. I think it is in all classes. The first year, of course, represents that sort of half-year ownership. That thing in terms of January versus December purchases. Okay. So much simpler than Canada. You just apply these percentages, and at the end, you've got nothing left. Whereas in declining balance, it continues for a very long period of time. What about for our network router? Well, very, very simple. We take the 10.5. It's a piece of electronic data processing computer equipment. So 5 years. 5 plus 1 is 6. You've got the percentages. You calculate D1 through D6. And that's your book value over time. It goes to 0 because you've written the entire asset off. What's the value of that? Well, present value, T times D1 through D6. Okay. So let's compare the methods. Now, the better method from a tax point of view is one that has the highest depreciation early on, because we get depreciation tax savings early on. And the two relevant ones here for taxation are CCA in Canada, the yellow dots, and MACRS in the United States, the blue dots. And as we can say, in the United States, depreciation charges are higher earlier on. Therefore, the value of the tax savings are greater for a similar asset here versus the United States. Or sorry, United States versus here. Okay. The other methods, a declining balance, remember we don't use for tax purposes, and straight line, the red dots, simply for accounting purposes, or franchises, or for non-intangible assets. Okay. So it's better to locate an asset in the States from a tax point of view. Also, I can plot book value, where book value is the undepreciated amount. Well, the more you depreciate sooner, the quicker the value of the asset drops from a book value point of view. So again, you would think that declining balance versus, MACRS versus CCA, MACRS should always be below. And indeed, that's the case. Okay? So that in the United States, the value of the asset drops to 0, okay, over 6 years, whereas after 6 years in Canada, you still have some value that you have to depreciate. Okay? And each of the points is higher in Canada, reflecting the fact you're not depreciating in this place. Okay? So you want, ideally you want to be able to write it off in year 1, get the tax savings immediately. That's not possible with capital assets. That's illegal. Okay? So you want a second best a jurisdiction that allows you to write it off as quickly as possible. Okay? So that's the comparison. And again, problem set 3 has that question that will allow you to have a look and see where you should locate the asset and how much difference it actually makes. Okay. Now, when I started this discussion, I talked a little bit about there are 2 ways of basically keeping your books. Okay, or a company keeps its books. One, the Chapter 9 view, the generally accepted accounting principle view, is the view with how much money did I make? What's my accounting income each year? Okay. Whereas the second view is, well, how much, what should I do to minimize my tax? So the 2 sets of books, and it's perfectly legit to keep the 2 sets of books. I think that's what most companies do. Now you might say, well, why should I keep 2 sets of books? Why not, since the tax world is the real world, ignore generally accepted accounting principles? Okay. And I'd like to give you an example here, which is really based on the network rudder that we've been carrying through. In terms of, I want to portray the profitability of this project to my shareholders. Should I do so from the tax point of view, or should I do so from Chapter 9 generally accepted accounting principles? Let's say I have this asset, and my net contribution, I'm making revenue from it, so net contribution, revenue minus cost each year is $2,500. So I'm going to keep the asset for its economic life of 5 years, and I'm making $2,500 before depreciation on the asset. How do I want to convey the profitability of that project to my shareholders? Well, Chapter 9 is the second view. Straight line depreciation says, is losing value $1,800 a year? I'm using it for 5 years. I'm consuming it up, if you will, over 5 years. And since I'm having a steady revenue on it, isn't perhaps a really good way of portraying this project. It's making me $700 a year. Right. And that's the accounting view. The generally accepted accounting principles would say, this project's a good one, it's making $700 a year. If I didn't do it that way, and simply presented the financial statements of the company along the tax way, what is it going to look like? Well, it's going to look sort of different. This project, according to the tax viewpoint, loses money in year 2. Why does it lose money in year 2? Well, CCA allows me a huge depreciation charge. Of course, I'm going to take it because I want to reduce my taxes. But is this project that has sort of level income and level contribution really losing money? No. Is it making a lot more money in the first year? Okay. Does it make piles of money in year 5? It is really a skewed view of the profitability of this project. It's what we're going to do for tax purposes, but it's not what I want to tell my shareholders. Okay? And so what we normally do is, we do it that way for tax purposes, financial analysis, and we do it this way in terms of shareholder reporting. Okay? Think about a project that had really high accelerated depreciation, like a satellite project. What would happen is the depreciation charges would be absolutely huge in years 1, 2, and possibly 3, which would show you losing piles of money. But indeed, if the satellite has a 10-year life and you're making lots of revenue, then indeed it may be very profitable. Okay. And so the fact that the government is allowing you unnaturally large depreciation in the first few years skews the results. So that's why there's the 2 views. The generally accepted accounting principle view is usually what we use for financial statements. But of course, we're always going to minimize our taxes. Okay, so that's the difference between the 2. This is really a summary of what I've just said. Key thing is that financial statements will use straight line depreciation that accurately portrays the project's financial contribution using that sort of level of consumption of the asset over time, uniform depreciation. Whereas we will, from a financial analysis point of view and a tax point of view, maximize the depreciation as quickly as we can for the tax savings. There is something called deferred taxes, which links the two, because in the end, you've only got so much depreciation, right? And the difference here is timing. You will be paying more taxes when you're using CCA late in the project, because you've used all of your book value early on. But the value of those taxes 5 or 6 years from now is much less than the savings associated with taking them right now. So you're putting off paying taxes, and that's the notion of deferred taxes and the accounting view of the difference between the two, because you have to recognize the fact that, you know, there's a difference. And so when you hear politicians complaining about companies that don't pay their taxes and have millions and millions of dollars on the books in terms of deferred taxes and how bad that is, that's nothing more than a result of them doing what the politicians have said in terms of depreciation. Take lots of depreciation, accelerate depreciation up front to stimulate certain parts of the economy. So that's the way to look at it. Okay, so that is depreciation, and again, there's lots of methods in the textbook. For the purposes of what we're talking about, straight line and capital cost allowance are the two that you're really responsible for testing purposes. And then zero will show up on problems at 3, but on no test, just for completeness. What we need to do now is ask the question, well, of the income that we bring in, how are we going to consider what is our taxable income and what tax do we have to pay? Okay. And so this part, and now talks a little bit about that and how taxes are levied in Canada. Okay. First part of this basically talks about, you know, we've got before tax options, we then have tax effects on those before tax Chapter 4 analyses, which then perhaps will change the ranking. And of course, after tax is what we're after, and that's how we're going to rank our projects. There are 3 levels of government with taxing authority on its citizens. Okay. There is the local government, like the city, City of Toronto. There is the provincial government, and there is the federal government. They all have the legal authority to tax citizens. Only the latter two can tax income. So cities basically raise most of their revenue through property taxes. If you live in the jurisdiction, they consider the value of the property that you own, and a certain percentage of that is levied as tax each year, property tax. About a percentage point or a little bit more. You know, so I'll have a $400,000 house, expect to pay $4,000 to $5,000 worth of property tax each year. Okay. And that's the case for local services, picking up the garbage, libraries, those sorts of things. Okay. Now, from a federal and provincial point of view, they have the ability to tax income as well as excise taxes, or otherwise known as sin taxes. So, tobacco and alcohol products have very, very large excise taxes on top of the sales taxes. Okay. Sales taxes basically are levied on consumption. So think about it, they get you whether you're living somewhere, whether you're owning money, or whether you're earning money, or whether you're spending money. Every activity is taxed. Okay. Owning property, property taxes. Enjoying yourself, excise taxes. Spending your money, sales taxes. Okay. And both the federal government and the provincial government, in our province now it's harmonized, so we use the same set of rules, more or less, between the federal and the provincial governments. The only province that does not levy a provincial tax is Alberta. Only they have the goods and services tax. Again, they have their oil revenue to help provincial costs. Okay. So sales taxes are considered a consumption tax, and they're a value-added tax, which we won't get into. And then finally, there's income taxes, which is really the major tax in terms of our engineering economic analysis. So sales taxes are just a percentage on top of what we buy, but many things are actually tax exempt for engineering projects, and only the final consumer actually pays. And income taxes are the significant ones we're going to look at. So let's consider how that works. Well, we are required by law to declare all of our gross income. Okay. So whatever income we have, we declare. The major source of tax evasion is a temptation not to declare. Put it in your pocket, you don't pay tax on it. If you're in the 50% bracket, it means you've doubled your money. That, of course, is very tempting. That, of course, is highly illegal. We put you in a lot of trouble. So I declare all of my income, and then I'm allowed, because the principle here is I'm going to get taxed on profit. Okay. And so to determine my profit, according to the Tax Act, I'm allowed all of my operating costs. Okay. I'm allowed depreciation. And if I borrow money and have a reasonable expectation of making a profit, I'm allowed the interest. That gets me to my my before-tax income. Okay. A percentage of that, 33%, if you're a large company, it's taxed, and what's left over is your after-tax income. Okay. And if that's paid out in dividends, your shareholders get taxed yet again on that. So there's very little left by the time you're finished with the government. So essentially what we're after is not so much after-tax income. We're after after-tax cash flow, because that's what we want to analyze in terms of our investments. And what we have here is a mix of things, right? Because we have CCA, which is a non-cash flow expense, so we need to figure out how does that affect my cash flows. Then we have interest. We have to ask the question, do we want to incorporate interest into our example, or do we want to use the cost of capital, which has all of the costs embedded, all of the financial costs embedded? And if we do, how do we reflect the fact that interest is deductible if I'm using the cost of capital? We'll have to adjust the cost of interest in that model. Okay. So this is the accounting view, and from a financial analysis engineering point of view, we want to then look at these things and say, how does this affect the cash flows? That's what we're after. The first aspect is really one that we've been implicitly talking about with DCFs and what have you, and I've formally introduced, is the notion of when I spend money on a business item, I get to deduct it one way or another. And for purposes of our course, there are really two things to consider. So let me use the general term expenditure, i.e. spending money. An expenditure can either be an expense item or it can be a capital asset. Those are the two possible categories which have different implications. Okay? So corporations, they're paying tax on their profits, and to arrive at their profits, we look at all of their expenditures against their revenue and decide what to do. For the purposes of our course, well, capital asset is really the most difficult part of all of this. A capital asset for our purposes in this course is a piece of equipment that we will use for more than 1 year, okay, and we are using it in the process of normal business. So a piece of engineering, telephone switch, for example, for the telephone company is a capital asset, right? Because they're buying the switch, it's going to last for a decade, and they're providing service on it. Okay? The company that makes the data switch, it's not a capital asset because they have no intention of keeping it, and they're not providing service. They're selling the switch. So a capital asset is basically from a customer or consumer point of view, the using department, the using company. Okay? And it must be depreciated. Anything else is an expense item. So if you ever are in a gray area, you always want to expense. I'm going to show you an example of a farm that actually looks at this gray area and tries to decide what to do. Okay. Why do I want to expense? I get to write it off immediately. I get the tax savings associated with it immediately. Okay. So I always want to expense. The Tax Act will say, no, it's a capital asset. You have to slow it down. How does an expense work? Well, you have to, the hardest part, I guess, about Chapter 5 is to think about things in terms of what's the after-tax cash flow impact of what I'm doing as an engineer. Okay, and that's what you're after, because you're always asking the question, well, I'm making this investment of shareholders' money. What happens after tax as a result of my engineering decision? So that's what this is all about. What happens to the after-tax cash flow? Well, let's say I have something, an expenditure, that the Tax Act will allow me to expense, i.e. write off right away. What is my actual cost? Where my actual cost, the one that I'm really interested in is, what's it really cost me out of pocket? So my only out-of-pocket expenses, what would I have had I not made the expense after tax? Right, so that's the key thing, looking at it on an after-tax basis. And the easiest way to look at this is to say, well, let's look at it before and after. Let's say I can get along in this business with $30,000 worth of expenditures. I'm going to make 50 grand. Therefore, my taxable income is 20. I usually use 40% as the tax rate. It's sort of an easy number to use. I'm going to pay $8,000 worth of tax, and my after-tax income, note this is not necessarily cash flow, my accounting net after-tax income is $12,000. Okay. Let's just say I decide the business is exactly the same to spend another $1,000. Okay. for whatever reason, a longer term thing. It's not going to affect my income statement today. What did that $1,000 actually cost me? Well, in Chapter 4, the answer is $1,000. But in Chapter 5, it's different. Because as a result of spending that $1,000 before tax, my allowable deductions go up. By definition, it's an expense. Therefore, my taxable income goes down, and my taxes go down. So think about the government being my partner here, and helping me pay $400 of my $1,000 expense. Do you believe that? The government is helping me here. It's only costing me $600 after tax. Okay. The flip side of this, of course, is whenever I make $1,000, the government takes 40%. Okay. So it's not like the government is being nice to me, helping me with this expense. It's simply reflecting the fact that every time I make $1,000, I lose 40. So the key thing, and what we want to pick up next day, is in terms of what is the after-tax impact of that $1,000. I'm going to argue the only thing that's important in a cash flow financial analysis is the $600, because that's really what it's costing. Okay, and that's the way we're going to look at things in Chapter 5. Okay, thanks. We'll see you tomorrow.
没怎么看绩效啊，就看薪资的。
300也明天考啊。
然后461本来明天考了，然后教授说改了后天。
差多少吧？咱也2300是吧？
对。472因为占很少，就不骗了。然后那个。